This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perney. Thanks for being with us today, and we are very pleased to welcome on today David Chan with Farm Together. We're going to be kind of exploring some different avenues of real estate investing that we haven't really touched on. We've at length covered the value benefits of investing in things like single-family homes, commercial multifamily. We've even will be getting into some really interesting stuff with industrial real estate coming up that I'm really excited about, and all sorts of different interesting things. And what we like to bring you is interesting alternatives with the Alternative Investing Advantage podcast. So again, David, thank you very much for being on with us today. Maybe give us a little bit of background about how you kind of came to be with Farm Together, and give us a little bit of a rundown of what y'all do, and we'll kind of jump into the interesting avenues of the specific type of real estate that y'all really enjoy pursuing, and we'll go from there. So thanks for being on with us today.
Excellent. Thank you, Alex. It's great to be here. So yes, again, my name is David Chan. I'm the Chief Client Officer and Head of Business Development at Farm Together. I'm also a member of the founding team at Farm Together. So I've now been with the company for a bit over 4 years. And what led me to join the founding team and want to start a company like Farm Together is making farmland more accessible to investors, both retail and institutional investors, because I think it is such an exciting asset class and one that has largely been forgotten or not squarely thought of, certainly not as common as many other real assets, like commercial real estate, like industrials, but even less so when you think of more mainstream asset classes like public equities or fixed income. So we are very excited about this asset class because it has shown to be incredibly resilient over the past 32 years, based on an institutional index that we follow, which is the NCREIF Farmland Index, or the NFI. And we've seen multiple cycles come through. Obviously, if you think of over the last 30 years, various different economic crises and global events. And despite all of that, over, say, 130 quarters, give or take, there have only been 2 where this index showed negative appreciation or drawdown. So I can't think of many other asset classes where you see that performance. We think it's an incredibly resilient and excellent asset class for capital preservation and diversification. And that's why we started Farm Together. We have several different products, which I'm happy to dive into in a bit, all of which are to allow retail investors and institutional investors greater access into this asset class.
Great. So, it's easy enough for people to kind of wrap their heads around, farmland. You get on the interstate, you drive, anywhere outside of a city, you're going to drive through some pasture land or farmland. But it's one of those things where, most of the time people just think, it's either one or the other, either someone like, ConAgra, or, your mom and pop with a little, farmstead and the, American Gothic pitchfork people standing out front, owning these things. But, just like with anything, if it's something that can generate revenue, if it's something that is a tangible asset, people are going to invest in it. And, obviously there is a spectrum, of the, Monsantos of the world. And again, the mom and pops that own these things, there's, obviously a market out there for people to invest in this. So I'm assuming that there's kind of a spectrum on this. Someone just doesn't go out and, lack of a better term, go buy a farm. There's probably plays insofar as that you're buying one for, someone to go in and then work that, or you buy something that operates more as a business. So maybe kind of break down a little bit for us and our listeners, what the spectrum of this is. When you talk about the position that y'all are taking in investing in farmland or arable land, what does that look like? Is it, something where there's multiple different ways to plug into this? Is there kind of one general avenue that you have identified as being the most profitable? Give us a rundown on, what it kind of means to invest in farmland.
Certainly, sure. So I think just like any other asset class, there's a spectrum of risk and return expected on our investments. So where an investor's particular investment objectives, risk tolerance, and suitability falls is going to determine where along that risk spectrum of offerings may be the best fit for them when considering farmland. No different than any other investment choice. So for us, starting with, I would say the most conservative, so lowest volatility, also lowest yield, that would be investing in row crops. Row crops are commodities that are planted every single year. So you're essentially acquiring bare land, but you know that that bare land is on healthy soil that is conducive for agricultural production. And so examples of row crop commodities would be corn, soy, wheat, beans. Those are commodities that, again, are grown every single year. You're typically looking at cash yields around 3% net and capital appreciation on the underlying asset on top of that. Very little volatility, very little risk. You do have counterparty risk, as we generally only would be leasing out row crops. We'll get into a different type of deal structure in a moment, but with a lease structure, our cash yield is derived from rental income. So that's where the counterparty risk would come in. But it's a very fluid market. Vacancy rates are essentially zero. So it's very easy to find a new tenant should you need to. And so, we find that to be the least risky, but also lowest yielding option. As we start to move towards higher returns, we enter what would be considered permanent commodities. So those are commodities that grow on long-lived assets like trees, vines, or bushes. We're underwriting these long-lived assets for an economic life of 20, 30, maybe even 40 years, where we're expecting cash flows to be generated from these trees, vines, or bushes for that period. Clearly, there's more value there because we're underwriting both the bare land value of the land, the economic life or the present value of the economic life of these long-lived assets. But then there's also inherently more risk. If a hurricane were to damage, trees on a pecan orchard, or if a drought were to stress almond trees to the point where their yields were permanently impacted, that would materially change the potential future economic cash flow of a property. So there is inherently more risk there. As a result, yields tend to be much higher as well. So when we're leasing or renting properties in a permanent space, we're typically looking at net cash yields around 6 to 8%. When we're direct operating, meaning we are paying an operating partner to do the actual farming and all of the management of the asset on the ground, and we are taking essentially market risk, where our cash yield is going to be derived from both commodity prices and commodity yields. Those tend to be more volatile, of course, because yields and prices fluctuate, but those cash returns can be north of 10%. So again, more risk, more yield.
Okay, cool. I was just taking some notes on here. So let's kind of, again, start at the beginning because there's some interesting things to unpack, I think, to kind of draw some correlations with what people are, definitely more used to when it comes to, again, this is a, real estate play at its, basis, and then it builds off of that. So you mentioned that things like row crops, so your soybeans, your corn, things that, and I'm just thinking out loud here, just literally that are planted in rows, that kind of have, they're seasonally, they're picked or harvested every year, correct, is kind of that first asset class.
Correct, yeah.
So with things like that, it's more of like kind of a single family rental. You have someone that comes on, they rent the land from you, and is there any type of revenue share from the underlying sale of that crop, or is it just basically you have the land, they rent it from you, and then they go and then sell their crop? I'm just trying to figure out how market like commodity fluctuations would play into that. So kind of break down at least the revenue generation from that. Is again is it a purely a rental aspect? Is there some type of revenue sharing with it that kind of plays into that risk and potential lower return? And is that are those seen as maybe a little bit safer plays, or again, let's just kind of break down to that, because I think there's some things to unpack to help people understand exactly how that might work.
Certainly. So first, what you said is exactly correct. This is a real asset investment. It is a corollary to real estate investing. We have two return streams, the income return and the appreciation. The income return is where you're going to be deriving income off of essentially, I call it like a binary event, which is rent. If you're leasing it out, you either get paid rent or you don't. If you don't, you find a new tenant. Or a variable component, which could be like a crop share, a profit share, or which would sort of be the medium option. Or again, we can go into direct operating where we're taking full market risk. And there, our cash return is operating income, and we're susceptible to commodity price movement and also yield movement. Taking a step back to the leasing structure, where when we're renting these properties out, it's really up to us as the manager, and also working with the client to understand what their objectives are, to define what type of lease agreement we want to enter. So we have lease agreements where it is just a base rent. And there is I wouldn't say a crop share component, but it's called a flex lease, which stands for a flexible lease. And what that means is we have just a base rent that's agreed to for multiple years, typically 3 years. But at the end of a calendar year, we look at the average, at least in our contracts, we typically use the average Chicago Board of Traders CBOT December corn futures contract from January through October. So we take that time series, average those different futures contract prices, and then we have a corresponding table. And depending on where corn futures have been, the rent for the following year may increase, or it may decrease, or it may stay the same. But that's responding to where commodity prices have been. And the spirit of that flex lease is if commodity prices are super high and our tenants' profitability has changed materially, to the upside, as the landlord, we should be able to capture a bit of that through a higher rent. Similarly, if the market conditions have changed materially to the downside and our tenants' profitability has changed materially there, our rent decreases as a result of that as well. So that's a flex lease structure.
Gotcha.
Any questions on that?
Yeah, and that was kind of leading into my next one is that, it's easy enough to kind of understand, looking at a single family home, okay, people are moving to the area, but, if you're talking about farmland, how do you peg the actual, pricing of your lease structure with that? And, kind of going into that. So, basically what you're saying is that, the underlying value of the lease is going to be determined by the commodity trading values of whatever that happens to be. You use corn as an example, but I'm assuming you draw the same corollary with things like soybeans or, strawberries or tomatoes, whatever, kind of goes on there. Is you're looking at the commodity trading price to kind of, again, if it's going up, then obviously, the value of that land to, grow that crop is increased, and then you would increase the rents accordingly. So it's just interesting to kind of see, again, because your farmland doesn't increase because they put in a Whole Foods down the road. People aren't moving to that neighborhood for that. It's, again, just trying to figure out how you're going to necessarily peg that. So, with that said, again, to break it down further to kind of figure out which one, to understand, which one might be more desirable, because you kind of said, hey, there's either the basic rental with the, flex lease structure, and these things, again, to your point, are typically about 3 years is kind of what you peg the, lease term at. So you have the flex, where you basically are saying, hey, someone comes in here and then the pricing is adjusted according to the commodity value. Or you have something where you get into more operational aspects of it, where, you're taking, again, I would imagine, more of the risk, but there's more reward for that. Where does the kind of the happy medium, or is it just is it based on, do you look at which one to do based on, what you're seeing in the market for that particular commodity, basically saying, hey, we're seeing that it's going to be more advantageous to position to operate, let's say, corn, versus something that might be more volatile, and we're saying, hey, the flex lease works better for something like soybeans. How do you kind of figure out which, direction you want to go with row crops, with going with that flex lease structure versus being a more operational aspect?
Yeah, that's a great question. And I think part of it comes down to market fundamentals, but part of it comes down to investor objectives. So for market fundamentals, in row crops, we generally have only pursued cash leases. Otherwise, if you are looking to directly operate in row crops, the economics, the unit economics in our view are such that you would need to farm and manage a portfolio of rather large size, so thousands upon thousands of acres in a small area. And essentially becomes a play at spreading your fixed cost. For our model, we are looking to offer investors options and diversification across multiple geographies. So would it make sense for us to have all of our row crop properties confined to one county in Illinois, or a couple of counties, right? So that doesn't really fit well with our model. And so for row crops, as a result, for us, cash leases make the most sense, and that is what we recommend to our investors. Outside of row crops, once we look at permanent commodities, it really comes down to investor preferences. We do offer permanent leases, which I think are sort of the middle of the road option in terms of risk and yield. You're still able to generate, say, 6 to 8% net cash yields. IRRs are typically projected to be net around 10%. And you are deriving your cash yield typically off at least a good chunk of it off of a rental basis. And then there could often be a variable component like a gross revenue share or a crop share involved. So that would be sort of the middle option for investors who want higher yields, but don't necessarily want the most variability that you could see if you do direct operating. Direct operating is a great fit for investors who do want the ability to capture maximum upside, but it's also a great option for investors who may have certain tax preferences or considerations where they're looking to generate depreciable value. In farmland, of course, you can't depreciate land. You can depreciate long-lived assets. You can also depreciate capital improvements and other CapEx projects. So in direct operating models, particularly when we're looking at developments where we're buying, say, an old orchard with almond trees or a citrus grove that is now past its prime, and we're looking to recycle those trees and plant a new varietal, it's going to take several years for that property to start producing a profit, of course, because we have to wait 4 or 5 years for those trees to become productive. But we're going to generate quite a bit of depreciable value from the purchase of the new rootstock, the planting costs, the development and cultural costs of those young trees. And then if there's any capital improvements, like let's say we're improving a well that's on the property, or we're enhancing and updating the irrigation system to be modern irrigation to reduce water loss. Those are all going to be eligible for depreciable value as well. And in our asset class, similar to probably what real estate investors may be familiar with, we benefit from special bonus depreciation considerations where we're able to accelerate the depreciation on depreciable value under bonus depreciation. And so that could be an option. Those can be options for investors who do have tax liabilities that they're looking to potentially solve for through new investments. That could be a great fit. So at the end of the day, there's lots of different options out there, and it does come down often to investor preferences and objectives.
Okay, so to kind of to move the transition from, let's say, row to more permanent, the basics of it are, in general, the row stuff is going to be more of a, either just set it, lease it, or, definitely more of kind of a business play. It's kind of leading into like the actual like trading and business of the actual commodity, getting into the more permanent stuff. And just to make sure that our listeners are kind of, when we're talking about permanent stuff, like you mentioned, you're talking about like maybe pulp trees, orange groves, nut production and trees and stuff like that, things that are planted that have a, again, oranges being near and dear to my heart, being a native Floridian. I've had orange grove farmers in my family. You have something that comes in and you have a 5 year runoff, potentially until you actually get an orange that you can actually take to market from that. So I'd imagine. Again, transitioning into this, there's a lot more corollaries that can be drawn from the tax perspective, because that's what, at least here at Advanta, we're all about, helping people with tax shelters and tax avoidance and different tax strategies, is that you have a lot more things that you can utilize that, again, draw some correlations between, let's say, commercial real estate in general. So when it comes down to something like that, that's more permanent, you don't have necessarily something like a cost segregation analysis you can do of an apartment building where you're depreciating different things at different rates. But how exactly does that play in? Let's say you've now acquired something that's going to be a more permanent issue, and you mentioned things like, you have to plant, you have, if you have capital improvements, are those the general things that go into that? Because if you have an asset that you've purchased that doesn't produce any income, how does that look, from an investor standpoint? I know people hearing that are going to say, okay, great, if I have something, am I just sitting on it? Am I eating costs? Like, where is the revenue generated from something that's more permanent if you have, let's call it a reposition that has to happen? If you bought, like, like you mentioned, an old orange grove that needs to be replanted, and you have those runoff years, how does that kind of work into a viable investment? Where does the cash flow come if you have that reposition event?
Yeah, certainly. Great question. So, when we model our development deals, we're considering what the cash budget is going to be during the development period, and we would source equity for that, or we would consider debt options. In the past, under a very different interest rate environment, there were lots of great debt options available. Recently, we have not been using debt nearly as often. But if the rate environment changes, we may be looking at debt options again as well. But we do consider what the development budget would be, and we factor that in to our underwriting. And so when we're showing projected returns to investors, it would be inclusive of those upfront development costs. I think the most important thing is to be very clear and transparent with investors on when they could expect a cash flow from the investment. So for someone who is dependent on income and looking for something that's income producing, a development deal likely would not be a good fit, because you're not going to see income for, potentially 4 or 5 years. For investors, there are investors who are trying to invest in deals that do not produce income. They don't want additional income right now, and so a development deal might be a great fit for them. So again, it does come down to preferences. But I think the heart of your question is basically the more or less the economic viability of a development and how to get a development from start to finish to the point where it can be self-sufficient and producing a positive net operating income. That would be encompassed by the development budget, which is something that we do underwrite and include when we are sourcing equity for a deal. Otherwise, I think we would be in a scenario where, if you only source enough equity to buy the property, and you're not considering the development budget, well, in year 2 and year 3, you're going to have net operating losses, and you're quickly going to get into a cash crunch where you would need to either source additional equity or you're not going to be able to pursue the development budget as needed. So yeah, for us, that's something that we would include in underwriting.
And also, I would imagine, and correct me if I'm wrong, and just kind of thinking out loud with what you mentioned, is that, again, to the more permanent stuff, when you have, again, that development runoff, is that something that is going to be generating either operational losses or things that the investor, again, to your point of the investor that says, hey, like, I'm making money, and for a tax strategy, I don't necessarily need the income right now. I want something that's a little bit more liquid, farther off. I need to generate some, again, paper losses or things that to write off against income. Is that kind of, again, something that might factor into someone going from, let's say, investing in something that's heavy on row crops, which is, generally, more of a cash flow rental structure, to something that might be able to generate losses and be able to put the revenue off in the future? Is that kind of maybe one of the aspects that might be attractive to some investors in that area?
Absolutely. Absolutely. So development deals offer the most depreciable value. An investor in a development deal would expect to receive a net operating loss likely for those first 4 or maybe even 5 years of the investment. And they would be able to potentially save those losses to offset against future income from that same investment, or potentially take those losses and apply them to other tax liabilities that they may have elsewhere in their portfolio. So many investors do find those paper losses to be helpful for tax strategies. And that is, in addition to, there are other reasons why development deals may be interesting for investors, aside from just, the depreciable value and potential tax efficiency. From more of a real estate angle, similar to real estate, the highest yielding, at least in terms of highest capital appreciation deals in real estate, are often development deals. And the same is true for farmland. So we would expect the highest capital appreciation to occur on properties that are development properties, and that would lead to higher overall projected net returns on the investment. So for a patient investor who is able to wait 4 or 5 years for their first income check, and say it's a 10-year holding investment, we would expect a net IRR for that type of deal to potentially reach the mid-teens, or at least be above, say, a 12% net IRR. Whereas a mature turnkey orchard, we'd still probably be landing around a 10% net IRR. because we would have a higher cost basis. A seller is not going to let go of an income producing asset that they know is going to produce, another 20 years worth of healthy cash flows, the same way that a seller who has an older past prime orchard is going to be looking at that sale.
Well, exactly. And again, to make the correlation, it's the same way of taking a, apartment building that needs, the pricing for an apartment building that needs a new roof, it needs the parking lot repaved, the pool has a huge leak in it, is going to be a significantly different price point than buying one that's already a, B, A minus property. Same thing goes here. You have that, you go in and buy something that is, again, turnkey. You're buying something that is cash flow producing. Let's just, again, it's a mature apple orchard that every year they have harvestable crops. You don't have to go in and replant apple trees. There's a different price point for that. Now, to the point of looking through this, obviously, your company, you're putting together investments in different packages and things for investors. Which one is it kind of a mix of the two that you look for? Obviously, you want to have different products for different people. Is one, again, inherently more attractive? I know there's, again, or is it kind of, industry specific of things that, you maybe shy away from just because of the issues? I know, for instance, citrus, you have huge issues with citrus greening. Are there certain crops that you might want to stay away from just because of inherent issues in that market? Or, is a kind of a fluid dynamic of saying, hey, here's stuff that, is attractive, things that we would rather get and reposition. Maybe kind of talk to the point of that of like, which ones you're seeing and trajectories that you're going in.
Yeah, we do target all. We think that we have a broad enough investor base that there are investor needs for each of those, or the full spectrum of products. There's more than two profiles, I would say, so I can't say each. We think that there's so many different types of investors out there with different considerations and preferences that we need to be able to offer, all the different flavors that are available. I would say that depending on commodity fundamentals, certain markets may be more primed for development versus others that, maybe we think are more interesting from a mature turnkey position. So I can give an example of that. Looking at some tree nuts right now, I would say pistachios have shown to be very resilient, even past pandemic. Prices have held strong. This year we are seeing price softening, but we are also seeing what will be likely a bumper record crop. We had perfect weather conditions this spring for pistachio production in California. So while prices are expected to be lower, yields and nut quality are expected to be exceptional, possibly the best year we've ever seen. So pistachios are a commodity that we would remain excited about, not only from a development standpoint, but also from a mature acquisition standpoint. Because if we are paying a higher price at acquisition for a turnkey asset, we want confidence that there's not going to be a market crash. There's not going to be a structural change to fundamentals 2 years after we acquire the asset, and now the cash flows that we were underwriting are significantly lower than what reality is. So we need to have a lot of confidence in the fundamentals of the market. Pistachios would be one, and are one that we are very confident that structurally the market is not going to be moving anywhere significantly. We have a pretty sticky demand base. Supply remains fairly confined. And so, we don't think that there's going to be much, there isn't enough risk to warrant walking away from turnkey deals there. It is worth looking at turnkey options. Whereas there may be some other commodities, trying to think, maybe some varietals of wine grapes, because wine grapes come in all different varietals. Consumer preferences can change often. So not speaking categorically on all wine grapes, but on certain wine grape varieties, there may not be as much confidence if we are looking at a turnkey asset that we could reasonably expect the cash flows for the next 10 years to look similar to what we've seen over the past 2 or maybe even 5 years. And so for an asset like that, maybe we wouldn't be quite as bullish or as confident moving into a mature acquisition, and we would want the benefit and upside of looking at more development or mid-development acquisitions to capture higher capital appreciation.
Yeah, it definitely makes sense. So you mentioned again capital appreciation kind of brings me into, what I've been thinking in the back of my mind of, obviously, cash flows are great, but at the end of the day you have assets and you're not going to keep all of them in perpetuity. So, looking at this, again, it from what you're kind of telling me, these things in general from the investor coming into an investment provider like you, the product that they're getting is going to be, relatively illiquid for the most part. You have something that is not necessarily, again, a tradable commodity, if you will. But at the end of the day, investors aren't going to want to necessarily just have their cash, sitting in one product for, again, until they pass away. So with your strategies with these, obviously, you're looking at things again, like you mentioned, pistachios having a very, robust market that you feel is going to be, very good from the, capital appreciation, the cash flow standpoint for the more permanent crops. But where does like maybe coming into selling a piece of this ag land, where does that kind of come in? Because if you have a great cash flowing asset, that's awesome. But also being able to sell, reposition, get into different markets or different types of again varieties of farmland, where does that kind of come into play with this? I would imagine again the row crops being again, none of this being liquid, but, the more tradable type of land saying, okay, great, I'm going to sell this. It's easy enough. Someone's going to come in, rent it. There's probably a bigger market for that. The more permanent stuff, maybe being a little bit sticky and more of a long-term play. Where does the exit strategy for these come in, or what does an exit strategy look like for these different types of, assets going from the row crops to the more permanent stuff?
Yeah, certainly. That's a great question. Well, first, before diving into that, I would say, I mentioned right at the beginning of our chat that we have multiple products, and one that I have not mentioned yet. We do have an open-ended evergreen fund, so that's the Farm Together Sustainable Farmland Fund. This is a general partnership limited partner structure, and with this product, we actually did have liquidity in mind. So I would by no means call it a liquid product, but it is more liquid than, say, a closed-end syndicated deal that we know we're going to be holding likely for 10 years. The open-ended product has liquidity redemption rights after an initial 2-year lockup period, and we call capital and can redeem capital on a quarterly basis. So for clients who do have either a need or a preference for potentially earlier redemptions than, say, a 10-year hold period, we do have one product, which is that open-ended fund that may be a good fit there. But to answer your question on exit strategy, which I think is an excellent one, I think for us, we think very carefully about which commodities and which geographies we are going to invest in. And when we decide on a commodity in a geography, it's extremely unlikely that it's going to be the only acquisition we make in that space, in that area. And the reason for that is a big part of our exit strategy is a co-location strategy, meaning we want to have multiple assets in a given area to be able to present a portfolio or a bundled offering to sellers, which is much more interesting to many different types of seller groups, particularly institutional buyers. So when we look at farmland, and the reason that we think farmland has been fairly inaccessible and has not been made a mainstream asset class by your typical large scale custodians or investment management firms, is because it's a fragmented market in the United States. Most farms are small. The average farm is not a 10,000 acre farm. It's closer to 1,000 acre farm, actually well under 1,000 acre farm. So the average farm in the US is a small farm. It is very hard to find deals that are north of $20 million in value. Institutional managers and institutional investors want to be efficient with deploying their capital. And so they're not interested in looking at a $2 million deal. They want a $20 million deal or a $50 million deal, and there aren't many of them. So for us as a firm, we're strategically positioned to target properties that fall in that valley of, say, 2 to 20 million, where those deals are too large for most individuals to consider, but too small for institutional investors. Our co-location strategy, however, is to bundle multiple small offerings and position that as a portfolio. So if we have 5 almond orchards all located within, say, a 50-mile radius, we can sell a potentially $70 million almond portfolio at that point, not 5 individual $10 million almond orchards or whatever it may be.
Yeah.
So that's a big part of our strategy and why it's very important when we're developing our internal thesis on a market, a commodity, a geography. We're not looking at that as a standalone asset thesis. We're looking at that as, are we comfortable making 5 or 7 or 10 acquisitions around this thesis?
Yeah, no, that makes sense. Now, when it comes to kind of again packaging, and again, you're kind of targeting, a particular type of crop. It's not necessarily is it geographically bound? Like saying like, I mean, I'm imagining most of this stuff's kind of grown in the same place. So, you have like let's say 10 almond orchards that you're kind of bundling together. They're probably going to be geographically bound. Or does that necessarily really matter? I mean, a crop I'm going to pick on is oranges. You have orange groves in Florida, orange groves in California. For that thesis to kind of run true, do they need to be co-located? Does that really matter so much, or is it mainly just based on the actual end product that's being grown on that arable land?
Co-location is quite important. So with citrus in particular, you mentioned greening disease before. That is a risk that we find to be quite high in Florida. So we have not made any citrus acquisitions in Florida.
Mhm.
We've made all of our citrus acquisitions in California, where greening disease has not proven to be as high of a risk. So, for that one consideration alone, that would be one risk where California has an edge over Florida. Another risk would be hurricanes.
Yeah.
There's a major risk of potential permanent storm damage in Florida, whereas obviously there are still environmental issues that are possible and weather issues that are possible in California, but not to the same extent. So
Okay.
from a citrus perspective, we've chosen California as the best option from a risk-adjusted standpoint. That being said, California is a massive state. So within California, there are over 300 different water districts that operate as almost, say mini regulatory bodies on how different geographies are able to use both surface and groundwater. So we have internally ranked that list of 300 plus water districts, and there are groundwater sustainability agencies or GSAs and districts that we believe are the most interesting and we do want to do business in and we do make acquisitions in. And then there are GSAs that we don't have as much confidence in and we won't look to make acquisitions in. So
Yeah.
another element of this is, there could be two citrus groves across the street from each other, but one is in one GSA and another is in another GSA. If those two GSAs operate very differently, your water rights situation may look entirely different between the two, and one may pose more risk than the other. So geography is important, and I do think it is an important element of our co-location strategy.
Yeah, and I would kind of again draw the analogy again for people that, I would say that's very analogous to, buying rental properties in a state with, very good or very poor landlord-tenant relations. You're buying somewhere that has very strong tenant rights or very strong landlord rights. So, it's kind of a mix of the both. Those are kind of the things that you're looking at, again, to kind of draw those correlations in what you're doing. Now, to kind of get into the asset structuring side of this, there's a few things I want to touch on that you mentioned. First being the evergreen fund that you run. Now, when you talk about a pooled investment fund like this, is this something where you're casting a broad net over again between row crops and permanent? Are you mixing a lot of stuff in there to diversify what people are seeing in something like that? Or do you have multiple ones for different asset classes? Maybe kind of break down again, the strategy that you're employing for, packaging that investment. Obviously, no secret sauce, but, kind of what's the general, packaging of the assets that go into something like that you've put together?
Yes, certainly. So for our fund, it is a diversified pooled vehicle. So that is one of the main advantages that we are offering clients who invest in the fund. They don't need to diversify their farmland allocation across multiple single assets. They're automatically becoming diversified by entering into this pooled vehicle. So for our fund, we do target a pretty broad slate of different geographies and commodities. We have a much heavier focus on permanent commodities than we do row. So we target 90% of the fund to be in permanent commodities and just 10% to be in row. And our targets are also by geography and commodity. So we're looking to deploy about 40% of the fund in California, 30% in Washington and the upper Midwest, 20% in Oregon, and the balance across Arizona and Oklahoma. From a commodity standpoint, we're looking to deploy roughly 50% of the fund into tree nuts. So that would be pistachios, pecans, about a quarter of the fund into tree fruit, which would be apples, pears, 15% into citrus, and then 10% into row crops, corn, soybeans. So that's how you get that 90-10 permanent versus row split there. And we also target predominantly turnkey assets for the fund. So the fund is meant to be an income producing option for investors. We are targeting a 4 to 6% net cash yield and an 8 to 10% net IRR. So it is a great option for investors who are looking to generate immediate cash yield in year one. And they're happy to give up a little bit of that potential upside or higher capital appreciation in order to do so.
Yeah, and I'm assuming that, with something like that, that's diversified, that would have some, again, into the permanent stuff that has operational losses. You mentioned as a GP-LP type structure. So would there be the tax benefit of, pass-through depreciation and losses paid out on K1 to the investor in that scenario from a tax planning strategy?
There would, yep.
Okay, gotcha.
Yep.
Now, getting into out of the, kind of the pooled investment fund to how these things are structured from an investment standpoint into the more permanent stuff. Again, you mentioned that, kind of the end goal is, get things, packaged and bound and then maybe have, an institution, then position it for an institutional investor that might find it attractive. Maybe there's an extra strategy there. But from the perspective of let's say you're putting something together, to draw the analogy to commercial real estate, is it one asset, let's say one, pistachio grove that you're putting together again, I'm using loose terms and I may not be using the right one, like a syndication for one, again, like the one grove, or is it something where, again, that's kind of what I don't know. How does that kind of structure from the investor standpoint to say, okay, I understand, we've covered the asset and kind of, how it operates, where the cash flow comes from, the general strategy, but how are these things kind of packaged when it comes into the investor side, say what are they looking at from what the investment actually is?
Yep. So investors with us and basically what our product suite is, we have security offerings, which would be the crowdfunded deals, crowdfunded syndicated single asset deals. There are 506c Reg D offerings. And so those are available on our platform. An investor would be investing in a security. They're investing in a partial interest in an LLC. The LLC is what is acquiring the property, and the LLC's name would be on the deed title to the property. And the investor would be eligible to receive whatever their pro rata interest is, commensurate with their LLC ownership interest. So to keep it simple, if it's a $10 million deal and an investor invested $1 million into that deal, they would own 10% of Farm Together 123 LLC and be entitled to 10% of all distributions, 10% of net proceeds when we sell that property, 10% of all depreciable value, net operating losses, etc.
So that would be paid out on just a shareholder distribution, not like a preferred rate, like the GP-LP side would. And is that paid out as just a member distribution, or what would the income look like on a stated K1 statement? Is it membership interest income? Is it derivative interest? What does that look like from the investor standpoint?
So the LLC is a pass-through entity, so it would be a partnership.
Okay.
And so the partner would have an opening capital account, and then any activity during the year, such as a net operating loss or income, would be reflected, and then their ending capital statement.
Okay, gotcha. And would that be classified? That would be still classified as passive income, correct? It wouldn't be.
Yes.
Okay, gotcha. I know that's. I always want to make sure that we're getting the passive income because the government likes to steal all the active income from you. So, I got jokes. I'll be here all day. But yeah, no, that's interesting. And those are going to be again more centered on the single asset. So again, that single pistachio grove. Or are there other plays that you have where again it's going to be bounded grouped assets where you have, or do these things go out and they acquire more? Do you call capital and acquire more with them, or are they again going to just be constrained to the one asset that they initially were established for the acquisition?
The crowdfunded deals are just single asset acquisitions. So whatever we're syndicating, it's dedicated to that one asset. The diversified option that we have is the open-ended fund, which I spoke about a moment ago. That's the GPLP structure, also a passive vehicle. Another option that we have for investors, if there are any investors who have perhaps a 1031 exchange that they're considering or looking to leverage a 1031 exchange, we do have a 1031 program in place with 2 products. One would be a tenancy in common or a TIC structure, where an investor would be a TIC member in an offering and they'd be able to do that through a 1031 exchange. The other would be an investment in real property itself as a what we call a bespoke interest or a separately managed account. So if there's an investor who wants to outright own a farmland property, they can do so through us. We would do all the acquisition work, underwriting diligence, and management work after acquisition. So it's still a passive option for investors who are looking for farmland in their portfolio. But for someone who wants to own a single acquisition, no different than if someone wanted their own multifamily investment or a sole ownership and whatever other flavor of real estate investment, that is an option as well, and that would be a real property investment as opposed to a security.
Cool. Yeah, no, I think we've covered. I could go on for hours. This stuff is incredibly interesting. I always enjoy when I get to learn something new after doing alternative investments for the past 11 years. It's cool to learn something new about what I've been involved in for so long. But that kind of brings us to the end of our time that we have today. David, I really appreciate you being on with us today. If people want to learn more about your offerings or get more information or possibly invest, how can they get in touch with you? Where can they find you?
Certainly. So our website, farmtogether.com, has a plethora of resources and a learning center. So it's a great space for anyone looking to learn more about farmland as an asset class. And if anyone has any specific questions for Farm Together or for me, they're welcome to reach out to me as well. My email is david@farmtogether.com.
All righty. Thank you very much. Well, this has been another edition of the Alternative Investing Advantage podcast. Thank you so much for being with us today and have a great day.
Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.